Hello, everybody, and welcome to this edition of the Home Run podcast, brought to you by Beeline Loans and RedAwning. I am your host, Alex Sendek, and today we are going to discuss the life cycle of buying and managing a short-term rental property. So to do that, we have a couple of guests today that I'd like to introduce. I'm currently with Chelsea Herkert, a senior loan guide here at Beeline Loans. Chelsea has a lot of experience with DSCR loans, with over 100 units closed in 2024 alone, with the vast majority being DSCR. Chelsea is our DSCR queen and an expert on all things non-QM. So we also have with us Andreas Bergeron, VP of Sales for RedAwning. He will be helping us walk through why so many experienced investors swear by RedAwning for short-term rental success. Chelsea and Andreas, welcome. Thank you for coming on today.
Hello.
Awesome. Thanks for having us, Alex.
Absolutely. So to start off, I think just a general flow of things, let's kind of start off on the financing side and just talk about when an investor starts the process, finds a home, and then is wondering kind of what loan's going to fit best for me. I know as an investor myself, I kind of was in that space where, I know obviously I want to make cash flowing properties work for me and kind of have that passive income, but wasn't really sure how best to go about it. We certainly have a lot of different options to discuss. So I think first of all, whether you're a new investor, a seasoned investor, realtor, mortgage professional, I found a lot of people have no idea what DSCR even means. And I think that's kind of a great starting point, Chelsea. So if you don't mind kind of letting us know, what is a DSCR loan?
Yeah, so DSCR stands for debt service coverage ratio. So it's a lot of words, and really we're just referring to the ratio of the income of the property as that compares to your mortgage payment, property taxes, homeowners insurance, and HOA if there is one. So a lot of people in the mortgage world know the PITIA, Principal Interest Taxes Insurance Association. So it's rent divided by PITIA. So a DSCR of 1 would mean your rental income, the dollar amount of the lease per month, is exactly equal to your PITIA. Anything above a 1 just means you're cash flowing more. So that's what it is, what it stands for. But I think a little deeper is there's no personal income on it. Right. So no tax returns, no W-2s. So that part alone shortens the experience, shortens the timeline, and just less documents to prepare. But it's really just a no personal income loan. Used for investment only properties, non-owner occupied, cannot be occupied by the owner in any way. Buying it in an LLC and renting it to yourself counts as owner occupancy because you are the LLC. But it's really purchase, refinance of any investment property. So any income producing property.
Now, I think you touched a little bit on the no personal income part, which to me, I mean, look, I got a few different things on my tax returns that can maybe sometimes make financing a little bit challenging. So you're saying there's no tax returns at all, like no matter what, like
none at all. And it can't be in there. I've had people say, I've got good income. Can you put it in there to juice up the file? When I say it cannot be in there, it cannot be in there.
Okay. Well, that's awesome. And also, yeah. I mean, and I think a lot of folks don't realize when we say no income and we're just looking at the rent, a lot of folks don't realize we can actually close this in an LLC as well, or even in some instances a corporation too. And I think that's, I mean, that brings a ton of benefit, especially for you investors out there that have more than one rental property. You're building a portfolio and you do want to limit your liability. Andreas, I mean, if you've got a short-term rental, LLCs are pretty clutch there. For obvious reasons. So we'll dive into that a little more later, but that's pretty impressive that is a product that, again, brings a big value that a lot of people don't know about. So, I mean, to segue a little bit more into that, I mean, everybody's familiar with conventional. When does it make sense to utilize a DSCR loan more over maybe a conventional route? Yeah, go ahead.
Well, you hit on the first one, LLC. If closing in an LLC is your number one priority, you need to go with the DSCR loan. It's just what you have to do. So
ineligible with Fannie Mae, I think, right? Can't even do that with Fannie Mae, I think.
Correct. You cannot close in that LLC name. Now, I'm not an attorney and I'm not going to dive deep into it, but people do it. They play that game. They change the title after closing. If you read the fine print on your conventional loan, there's some very ugly language about doing that. So
it's a little bit hairy, absolutely, right?
Yeah,
so, yeah
it's not worth it. It's not.
No.
The rate isn't that different. The terms aren't that different to take that risk. It's just not worth it. Now, so the LLC is the main point, right? If you have to close in an LLC, you want to go DSCR. A conventional loan also has a set number of properties you can own at one time. So you may submit an application, your income is fine, you don't think there'll be income issues, and you've got 10, 11, or 12 properties. They may say, income's good, but guess what? You're maxed.
Yeah.
So another reason you could swap over to the DSCR product. And if you're self-employed and you make great money, but an underwriter gets a hold of your tax returns and they decide that you don't make any money, because for self-employed borrowers, we're going with the, adjusted income, not the gross.
Oh, yeah.
Again, you hop right over to DSCR, no income in the file at all.
We've all heard those horror stories, I think.
Yeah.
So, I think everybody can attest. Self-employment can get a little hairy conventionally. When does it make sense maybe to go into a conventional loan over DSCR? I mean, I think that's important too. I mean, Beeline, I know, offers both products and including a bank statement product for self-employed. So we got a lot of options to offer. We're not going to focus in on those, but when would conventional maybe make more sense, would you say?
I think the only time you would do it is if, let's say you're buying a property and what you're going to earn on it, right? What you're going to charge. You have the market information. But for the sake of a DSCR purchase, the income on the property is based on the appraisal. So there'll be an additional page on your appraisal. It's called a market rent analysis. So the same way an appraisal shows other properties that are similar for sale, it will show other properties similar for rent, and it will pull that number. If that comes in low because there just aren't good comparables out there, or you're going to do midterm rental, so you're going, whatever it may be, you can charge what we want. We're not forcing you to charge less. But if that number on the appraisal, that income, is now way below what we're telling you your new mortgage, principal and interest, PITIA, mortgage or principal, interest, property taxes, and insurance, your rate is going to be awful, because now we're lending on a property that, based on the numbers, is not cash flowing. And if it's so bad, we won't lend on it at all. There are ways around it. You put more money down, you move to an interest-only product. But that's really, most people start thinking they want to go conventional and go DSCR. It's very rare that someone comes in wanting to do DSCR and goes the other way.
The financing terms are attractive conventionally, and I think that is important to note. I mean, look, DSCR pricing can certainly get in line with conventional, but I've seen a lot of new investors too, right? Where it's just, hey, maybe we're not quite at the level where we need to go DSCR. You have the income to show on paper, and hey, maybe that first time it's best to just get a conventional deal in. You gain that investor experience.
Exactly.
And as you kind of max out your debt to income ratio, it's going to happen naturally. You're going to move into DSCR one way or the other if you continue to build, that portfolio just from either you hit too many finance properties, to your point, or you just max out your debt to income ratio. Then you have that DSCR deal. And for all those listeners out there, I do want to explain a little bit more about what Chelsea's saying on the DSCR aspect regarding the appraisal. So what she's saying is conventional, we can define our income a lot more straightforward. right? We know up front what our income is. With DSCR, when you're purchasing a home, a lot of things do ride on that appraisal rent, right? The appraiser is going to say what the fair market rent is ultimately. So up front, we're kind of estimating as best as we can what that rent will be, but ultimately that appraiser makes that determination. So it does kind of remove a little bit of that gray area, right? I mean, just as far as, qualifying for either product. So. And okay, well, so now we kind of know what DSCR is, and now we kind of know the differences conventionally versus DSCR. But, what are kind of the misconceptions about DSCR, right? Like at this point, if you were to hear this, you think, all right, what's the catch? What am I missing here? What's the myth, right? So I guess if you were to say, what's maybe a frequently asked question or just a misconception you find often with folks that are unfamiliar, what would you say that is?
The unfamiliar folks always go, what's up? It's too good to be true. What am I missing? Tell me the bad part. And I tell them my opinion 100% honestly. The best rate for a DSCR loan, whether we're talking about a refinance or purchase, is going to have a 5-year prepayment penalty. Prepayment penalty is not a dirty word. It is not the same as a balloon payment. It doesn't mean your loan changes. It's just, let's call it a 5-year prepay, that's the longest and gets you the best rate, right? Yep. So that just means if you pay off that loan, if you prepay the loan in 5 years or under, you have a financial penalty.
Yeah.
So that, that's the downside of it. I would say that, and that rates can be slightly higher. But when you're talking about investment properties, you're really talking about someone else paying the mortgage. So it's not like a primary residence where your income is your income. On an investment property, rent has increased drastically lately. What else has increased? Rates. That's, it's not a coincidence. They went up together. So the sensitivity isn't there to the rate as much with an investment property. So too good to be true. Huge. That's what people ask, right? And it's not, right? And then another thing that people sort of misunderstand is they think because we say no income, it means no doc loan, no documents. Those don't exist. If they did, I'd be selling them all day because they would all get to closing. But there's no such thing as no doc loans anymore. No personal income just means no income documentation. So W-2s, tax returns. If you're a multi-business self-employed borrower with many K-1s, many 1099s, that can be a nightmare to qualify conventional. And people think, I think they also think, because I've heard it, they think the rates are going to be way higher than conventional, and they're not.
No, they're not at all. And honestly, I think a lot of those misconceptions are just fear-based from when, maybe back in maybe 2007, 2008, 2009, when there was that mortgage crisis. I think a lot of people think DSCR and it takes them back to there, where this is certainly nothing to do with that at all. We certainly we're appraising our properties. Thank you very much. We are making sure the property cash flows. We are making sure you have good credit. And we're making sure you're bringing a down payment. We are not doing zero down on these deals. We are. That's another big one, right? We get a misconception thinking no income, maybe nothing down, right? That's not quite the case, right? So it's a great program. It's not a magic wand, right? So I think that's important to know, right? I don't know. Anything you want to add about the down payment parts and just kind of where that aspect lies? Because I think a lot of people still are a little confused on, what that even really looks like.
Yeah, I think, and I mean, just to go back 1 second, people that sort of sometimes think this is too good to be true, there's no way. The explanation I always give them is, think of being a kid riding in the car and driving past shopping centers, right? I promise you that those multi-million-dollar shopping centers, they weren't like, here's my W-2. So these loans have been around forever. They've just made it easier for borrowers to get. You used to have to be a very experienced investor, multiple LLCs to get it. They've just opened them up more because conventional loans have become much harder to qualify for. So I think that is one big misconception that I just want to touch on. I don't want to forget that. They've been around forever.
Yeah. And that's
Um,
like a really good point. I've never even really heard it put like that. And that's an excellent point, Chelsea. So sorry to cut you off. Keep going.
No, that's okay. I'm rolling back because I thought about it. But
That's right.
in terms of preparation, so down payment. So like any investment property, there's a 15 to 20% down. I would assume on a DSCR loan that you're going to put 20% down. The 15% options are few and far between, and especially for a short-term rental, you're looking at a minimum of 20 to 25. So having that before you go start making offers and risking your earnest money deposit is important. Having realistic ideas about the potential rental income. I think luckily when you're dealing with a company that specializes in short-term rentals, they can get you a better idea. Sometimes people just are told from a real estate agent or someone that, oh, this is what it will rent for a month. And when we sort of start digging, it's nowhere near that. So keep in mind, again, it's not what you think you can rent it for. You've been told it can rent for it. It's what's on the appraisal, unless it's already a lease.
Yeah.
There's already a tenant there. We'll happily get the lease from the seller.
And those short-term rentals too, it's an added layer because we don't have that lease, and we have to rely on that appraisal data even more, and that's where it becomes even a different level of expectations as far as what you expected to rent and what the data shows, right? And we got to be careful there because we want, we certainly hear, lots of investors saying, hey, I'm going to make six figures on this rental property easily. And I don't doubt you. I absolutely believe you. But these appraisers have to find that data somewhere, and it's a little challenging these days. We're getting better at it. We're seeing appraisers a lot more experienced with kind of performing short-term rental analysis. But again, that's an added layer of just I don't want to call it difficulty, but just something you got to be aware of when you're applying for these loans. That appraiser needs to have data to be able to get you that short-term rental income to qualify for a DSCR loan, right?
Yeah. There's certain areas when you look at like
actuals.
Sorry,
do you guys take into account actuals, or is it just
took it right out of my mouth?
Whoa, that's like our favorite thing in the world. So if you have a 12-month look back from the seller, or if you're doing a refinance and you have your own look back, that is a magic wand. We're able to just kind of we're skirting past the appraiser entirely in that, right, Chelsea?
Oh yeah. If we can get that, that's what I was going to say. Certain areas, the coast, Colorado. I've got one gentleman looking to buy in Hawaii. The property he's buying has been a short-term rental for like 3 years. So that's fantastic. If it's already one, same as if there's already a lease standing, we just grab that information from the seller and roll with it. So in your position, and on your side of it, you guys probably have that 12-month look back already.
Yeah, 100%.
Yeah.
And then also, and let's be clear too, if you're buying a place in Myrtle Beach and you don't have
plenty of evidence,
there's going to be plenty of evidence everywhere. You're going to be fine. If you're buying in rural Alabama, for like a hunting lodge, that's where we can maybe get a little bit more challenging in that type of appraisal, right? So location certainly matters. Right?
And LLC docs, I will say, is an important preparation. I think sometimes because you can buy in an LLC, if you already have an LLC, great. Buy in the name of the LLC, titles in the LLC, loans in the LLC. There are some people that say, well, I'm going to wait to create my LLC until an offer gets accepted because they're buying 123 Main Street and they want the LLC to be 123 Main Street LLC. Well, we need a certain set of LLC docs, and there's one. It's your proof of EIN. It's not something you can print from the Secretary of State website. It's something that they mail to you only. So if you're waiting till you're under contract to register that with the Secretary of State, you're assuming you go under contract and create that LLC the next day, you're talking about 10, 15, depending on the state. We had one state it took 2 months, but 10 to 15 days before you get a document that we need before we can put the loan in underwriting. So setting up that LLC is important.
100%. Is a great point. Okay, well, great. And then, just kind of moving on from there, I know, I guess a lot of folks have a lot of questions as far as how do I proceed when I I know I want to I know I want to buy a rental property. I know I want to use DSCR, but how do I prepare myself best, right? I mean, a lot of folks are like, well, do I go ahead and get pre-approved now? Or do I wait until I find a home? Or what's kind of what do you tell your clients, Chelsea? How do you go about it? Because I got a way as well, and I'm curious to know how you go. Yeah.
I think for me, I'd like to have a conversation with my borrowers. And if it's someone that's very familiar with the conventional loan process of run my credit, here's my income, tell me what I can buy. For my DSCR buyers, it's totally different. For me, my pre-approval is a conversation, a lot of what we're talking about today. Understanding where the income on the file comes from, that's always part of my conversation. Making sure you have the assets for the down payment and closing costs, so that's similar to a regular purchase. But I just like to make it very clear about the income side of it, right? That they can charge what they want, but for our calculation of the loan, it's coming from the appraisal or an existing tenant. And then, I like to give them a rate, do a rate quote. So they've got their little mortgage calculator in their phone. So while they're shopping, they put the loan amount and the rate in, add the taxes and insurance, and then they are, in essence, calculating their DSCR ratio and making sure it's cash flowing. So that's my pre-approval, because I can't just tell you, I say, at 20% down, what's the most you'll spend? And they'll tell me, and I'll say, okay, you're pre-approved up to that amount. You don't have to spend that amount, but understand this. So I also sort of sometimes make a joke and say, you're pre-approved to buy until you run out of down payment money. I don't suggest that, but that's your pre-approval.
That's a great way to work. You almost work backwards. You're saying, how much am I willing to spend? And then you can work from there. And then you realize, I kind of do very similar situation, right? So I tell folks, hey, get a blanket base application in the file.
Mm-hmm.
I can we get your credit sorted, we get your assets sorted, everything's cool. And then each property is obviously going to cash flow uniquely. So you just go text me, right? You text me a link to Zillow, you text me an address, and you say, hey, Alex, I'm looking to put an offer in for X amount. What do you think at this property? You can hop in real time over here at Beeline and just say, hey, judging by these property expenses, et cetera, this totally works, right? Keep it rolling. So I think we're both pretty aligned on how that works, which is great. And then, just when we pre-approve, I guess the next logical question from most of our investors is, what rate should I expect for a DSCR? You know what I mean? I think that's maybe question one, but what would be your response there?
So at that point, we would have either a soft credit check, or I would ask, what do you estimate your credit score to be? Because that's a huge part in how we calculate rate. So we're not going to go into every rate, every loan to value, but for a purchase, assuming 25% down with 700 or better credit score, you're going to be anywhere in that 6.75 to about 7.5 interest rate. I know that's a wide thing, but go ahead.
Today's date's March 26, 2025 , by the way.
Oh, okay, yeah. Yes, to make sure that's important.
Rates could change.
Could change drastically.
They're kind of in line with conventional, right? Like they're I feel like in some situations I've seen them better. So
they are. I've priced some where just for my knowledge too, I put them side by side. And with investments, you can always, just like with the primary residence, you can always buy that rate down. Most times buying the rate down is less expensive than putting more money down to get the lower rate. In other words, like a $5,000 or $6,000 buy down may have more of it may affect the rate more than putting another 5% of the whole loan amount down. So based on your investment goals and what you prefer to do, there are ways to move that rate around, but very much in line with conventional. And cash out rates, depending on the loan to value, are similar to that as well. So
Yeah.
not so far off. I mean, that's, I think, part of the reason why some people that qualify for conventional, sometimes have been through a rough go with a conventional lender, because that's how conventional underwriting is. They look at everything, that they go, you know what, for $20 a month due to the difference in rate, forget it. Just put me in the DSCR loan and, throw out my tax returns, forget it.
And I think just risk equals rate, right? So like, I mean, think about the value you're getting. You're very, very similar to DSCR, and conventional pricing are very much so aligned. And yet you're not having to supply an underwriter with any of your personal documentation. That, at face value, from a lender standpoint, is a riskier deal considerably. And the fact that we're able to leverage that deal into a similar conventional product, close in your LLC, not a bunch of hassle, I think is a major benefit that a lot of people just need to realize. And with that, I know that one thing that people always come back at is, well, there's prepayment penalties, aren't they? Like there's a PPP. I don't want that. Should I be worried? What's your kind of response there?
Yeah, I think they see or hear the term prepayment penalty, and it's a lot like what you said. People jump back to '07, like, well, what happens, So your loan doesn't change. There's no balloon payment at the end of a prepayment penalty. It just means, like we were talking about earlier, if you pay off the loan, if you select a 5-year prepayment penalty, if you pay it off before 5 years, there's a monetary penalty. Now, in some cases, I've refinanced loans for people, and we just roll that prepayment penalty into the new loan, right? If it's worth it, say your prepayment penalty is $8,000. Well, $8,000 rolled into a 30-year mortgage, who cares, right? And that's only if rates have come down enough for it to be worth it, or in a situation like you purchased it, maybe you did some renovations and repairs, now your value has gone up, so you can pull money out. Yeah, pull some money out, or even not pull money out, but because your value is now higher, you've got a better loan to value on the loan, so refinance for a lower rate. And you can't predict what time is going to do. So saying, oh, I don't want a prepayment penalty because I think rates are going to come down. Well, we said that all year last year, and every time the Fed decreased the rates, they went up. So
and not just that, but I mean, it's not like the prepayment penalty terms for the entire duration of the loan. It's not a 30-year term. We do prepayment penalties from anywhere from 0 to 5 years, and I think what a lot of people don't realize is we're not forcing you to do any prepayment penalty. You can do 0 absolutely all day long. You can tailor up your prepayment penalty terms to whatever you're comfortable with and whatever your short or long-term goals are with the house. So if you're like, hey, I'm going to buy this thing and I'm going to sit here and, cash flow it for the rest of my life, we'll take a 5-year penalty, get the lowest rate you can on it, and ride it out. Or maybe you're not sure, you're uncomfortable. Well, great. You can do anywhere from 0 to 3 years or something, whatever you're comfortable with, right? Like it's not the boogeyman is what I'm getting at, right? Like it's something that it works for you. It's not a negative in my opinion at all.
Yeah. I think so many people associate prepayment penalty with some sort of balloon payment that, or some sort of change in terms. So that once that 5 years or 3 years, whatever it is, falls off, nothing else changes to the loan. That penalty just falls off, and you keep it moving. And on some DSCR products, I don't want to say all, some will allow you to overpay up to a certain amount every year towards the principal, but do not take that as the word, because some DSCR loans do not allow $1 overpayment. So make sure you get clarity about that before you just start you overpay by $20 and all of a sudden you're hit with the full prepayment penalty of the loan. So just make sure.
Great. That's excellent feedback right there. And all right, well, listen, I think we've pretty much hit everything we can on the purchase piece of it. And I think really all that's left is let's talk a little bit about cash out. I think a lot of people don't realize, even
My
if
favorite subject.
they just don't have everybody's favorite loan, the cash out refinance. A lot of people, I think, don't realize that that's an option too. So, what do you see out there? You see any investors kind of leveraging their deals? Do you see a lot of folks using
Like
cash outs
always
for
see.
buying some more rentals? Right.
Mhm.
I think that's a pretty big thing in our industry. What do you think?
Huge. It's, if you own an investment property with equity, I always make a joke that you've got dollars and cents and bricks and drywall. You can't take bricks and drywall to the bank. But you can, the same way you do a cash out on your primary residence, you can do a cash out on an investment property using that same DSCR or debt service coverage ratio calculation. So now this time, instead of depending on the appraiser to determine the market rent for us, you already own the property, you have it leased. So now our income is 100% clear and complete at the beginning.
Easy, right? It's
Very
like it's
easy.
easy as it can get. You already have the DSCRs already laid out up front. There's no, gray. It takes out all the gray area. We know exactly what we're doing.
Yep.
We're done in 3 weeks or less, sometimes 2 weeks, right?
Oh, yeah.
You get your money, you get your down payment money to buy more properties, to expand your portfolio, home improvements, whatever the case. But I think
down payment on the next one is huge, and there's no limit. Like there's no limit to how many you
we
can
can do this
do.
in perpetuity. We can do this as many times as you want, as many. And yep, that's right. And it always drives me crazy. I see all these investors with free and clear properties. That's great, but the opportunity to turn one house into 5 is it's right there. So a lot of folks, I think, just don't realize. So. Well, thank you so much, Chelsea. I think we've kind of gone over the funding aspect. That was, I think, a ton of great information for our listeners here to just kind of get a much better understanding on how to get that funding for that short-term rental. Andreas, I know you've been sitting here waiting to talk, and I appreciate your patience. Easier to explain the managing aspect of short-term renting. As an investor myself, I've always been kind of nervous about short-term renting. I'm not going to lie. I have a lot of friends. They all say it's a lot of work. It's a lot of work. And that's always kind of shied me away from it. I'm a busy guy. I don't have a lot of time to be messing around with Airbnbs. So I guess, Andreas, if you can just start off with, tell us a little bit about RedAwning and what you guys kind of bring to the table.
Yeah. So overall, we're a short-term rental property management company. We've got over 20,000 properties across the U.S. In all of your major short-term rental markets. We provide kind of a handful of different solutions and services depending on what you're looking for. So if you're looking to be more involved, or if you're looking to be less involved, or you want a white glove service, or the way that we make money is a revenue share. So we take a percentage of whatever the property makes. So if the property's not making any money, we don't make any money. If we're doing a great job and the property's making a ton of money, we take a percentage of that. And so it just depends on, how involved you want to be in the process. And we kind of have, a couple of different services you can select depending on your involvement and what you're looking for. But overall, I think short-term rentals as a whole, as we've discussed, can, provide a very lucrative investment, especially when you're comparing it to long-term rentals. They're a bit more volatile, but overall, you're going to be able to see a lot higher ROI on your investments.
I've seen some investors enjoy some 6-figure gross, I think even net profits. I don't know. I mean, I don't know what you're kind of seeing, but I mean, in a lot of these situations, people are making a lot of money. I don't know if you have any feedback there, but I mean, on average, I mean, are you seeing a ton of folks just doing great?
I think there's a difference between a lot of our investors, I would say, are like accidental landlords. Obviously, if you're doing a DSCR loan, you're not going to be an accidental landlord. Typically you're growing a portfolio. When you're, running this like a business, people are targeting the best markets, the best properties. They're thinking about how can we maximize square footage? How can we maximize the beds and the baths, and then maximizing heads and beds is what we call it for short-term rentals. So the more heads you can get in beds, the more you can drive the ADR, which is the average daily rate, and then the more unique of a place you can have. So we're talking about like tiny homes, talk about like ski in, ski out properties, think like Vail, Breckenridge, Aspen, Tahoe, think of like Miami, think of those like vacation destinations that people want to go to. And then, you do obviously have more risk too. So, I mean, like when you're renting out these bigger places, they're being rented out to, if you're trying to maximize those heads and beds, it could be 10 to 20 people. You do have to deal with, bachelor parties and people, throwing parties, but that's also where, you're getting, you could be getting thousands of dollars a night. The difference between the long-term rental revenue is typically 2 to 3x on short-term rental revenue. And so, I think that's where like the volatility comes into play with seasonality, and then, just really being able to, go after that additional return. And then I think a lot of people have the misconception that there's a lot of additional risk. But over the last couple of years, like the major platforms like Airbnb and VRBO, they have their own insurance in place. We also have our own insurance in place. So if things go wrong, you're covered. So you don't have to worry about that.
That's awesome. God, that gets me excited just even thinking about wanting to hop on Zillow and getting myself another short-term rental right away, to be honest. That sounds like you guys are making it pretty easy. How do I, if I were to do that, like, how do I even get my property ready for short-term renting? Like, is there any tips you'd give to a new investor on maybe something to do before they even go to RedAwning, or do you guys kind of tackle it all with them, or like, what does that look like?
Yeah, I think getting ready, I think the most important part is permitting, especially if you're talking about this from an investor standpoint and you're purchasing this property with the DSCR loan. You need to make sure that you can actually short-term rent the property.
Shout out New Orleans, by the way. That's a tough one.
Yeah.
Sorry, Andy, my Airbnb guy in New Orleans on my bachelor party. Sorry, buddy, if you're listening. That was a rough one.
Yeah.
Anyway.
Yeah, there's a lot of tough markets, and they're getting, I think it has pros and cons, right? So like the whole goal of the permitting and like the regulations process is to keep, like, really what it is so that the government can get taxes, but it also keeps in place like supply and demand. So it's actually a positive thing for investors, because if there was no regulations or no permitting, then you would just have an influx, which has happened in many markets where there's no regulation, and then you just have infinite amount of supply that comes in. And what does that do? That drives down demand. And now all of a sudden, maybe you did get a loan, and then a year later, you found this property, and now it's not returning the returns you expected because there's no regulations in place. So overall, I think regulations and permitting are actually a blessing for the investor, because it keeps things, checks and balances in place. So first thing is permitting. Then I would say, you want to renovate it. Like, people want to be in a nice home. Like, they're going here for a vacation. Setting your property apart from all the others, right? There's a lot of supply out there. You want yours to be the quality one. And then you want to, figure out what those amenities are that you can have. Is that, a hot tub, a pool? What are the things that you look for when you want to stay? How do you create that experience? And then, furnishing, that's a bit of a cost up front, but having quality furnishing that's like, decent design, as well as, nothing that's sentimental or, really expensive or irreplaceable. Things that go in easy, come out easy, and can be replaced, and you're not going to be worried about it. And then lastly, just getting all the essentials in place. So, all those kitchen supplies, linens, towels, everything that just makes it easy for somebody to show up and enjoy their stay without having to worry about anything else. I think those are kind of the main things to think of when you're thinking about getting ready for a short-term rental.
Yeah, no, that's all excellent feedback. I can definitely see how all of those would be super important. I mean, look, when we're talking about these folks getting things ready for their short-term rental, I mean, I know you have more experience than anybody else as far as, who's a player out there and who's kind of average when it comes to setting up their Airbnbs. Like, this kind of plays on what you just said, but what really kind of separates that top performing Airbnb or top performing short-term rental from just kind of a middling or just middle of the pack type of Airbnb? Is there anything else you might want to add there? I mean, I know it's not just buying it's not all about price, right? It's not buying the fanciest luxury place all the time. There's other stuff in play too, I know.
Yeah, I think first off, like, selecting the right area, of course, when you're thinking about real estate. So location, 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 then heads and beds. So making sure you can maximize the head and the bed count, which typically means square footage, and, a larger, maybe that's renovating a 3-2 to a 5-3, like how can you maximize that square footage to fit more heads and beds? And then like selecting the right market. So not going after too oversaturated a market that is growing, a market that's stable, that has a good vacation rental economy that's not going to change. That's what I would say is on the location side when it comes to like finding an above average location. And then when it comes to the particular property, its uniqueness and its amenities. So it's just think of the things that you can search for. And really the majority of traffic all goes through Airbnb. Like, you're going to get some Airbnb, VRBO, Expedia, Booking.com, but really like those are the big ones. And the majority still all come from Airbnb. So like when you're a user on Airbnb, I know when I go to book a place, when I just went up to Mammoth the other weekend, the first thing we were looking for is we wanted a hot tub. So we didn't look at any places that didn't have a hot tub because we wanted to jump in the tub after skiing a long day. And so we didn't even care about what the price was, right? So now all of those can be price setters, whatever that price is, and they can ask for more money on a nightly basis.
It's funny you keep touching on heads and beds, because when I'm booking an Airbnb or any type of short-term rental, I'm generally rolling with the crowd. So heads and beds is super important to me, and having the ability to make the most of my Airbnb and not to put as many folks as I can in there, but kind of like that makes a big difference, right? Especially for those bachelor parties or weddings or whatever you got going on. It's great to have. I see what you mean with wanting to maximize heads and beds. I think that's super cool.
Maximizing heads and beds, and then also like, having those community spaces. So like those big living rooms, those cornholes, like home theaters, steam shower, sauna, like a fenced-in yard for dogs. Like that's something unique.
Like those pool tables with the video games.
Yeah, how can you enjoy it? How can you see yourself enjoying it? And then think of who's booking it, right? The person who's booking is probably the person who's organizing it. So have a nice master. Don't skimp on the master, because that's the person who's making the decision.
I'm booking my flights. I'm always making sure I'm the first one to arrive.
Exactly.
I'm booking my early flight so I can go ahead and scout out those houses quick.
Yeah, those are all the things I think from like the physical asset that you can do and that you can manipulate. And then of course, like the actual management of the property is very important. So like responsiveness to guests. And then like, the expectation is that like people expect hotel level service. So they expect to be very quick responses, to have the information that you need, and for it to be quick and easy. And then also like pricing everything at the right time, the same way with airlines, right? When you purchase a flight, like imagine if Southwest, for example, or United was constantly $50 more expensive than every other flight going from San Diego to Denver. Nobody would ever purchase that flight. That's the same way it is with your Airbnb. So if you're not pricing yourself right every single day in every single situation, then you're going to be constantly priced out of the market and you're never going to win. So you need to be using daily dynamic pricing, and you need to make sure that the company or if you're doing it yourself, that you're using the best in class pricing systems to make sure you're always going to be winning. And then making sure your cancellation policies align with seasonality, as well align with what other properties around you are doing, because you want to make it easy for people to book it. You don't want to be strict. You want it to be, but you need to have the right balance so that you're not getting a lot of cancellations and then don't get the revenue you need.
Got it. And you talk a little bit about property management specifically in that last kind of exchange, I guess. How do you guys evaluate property managers?
Yeah, I think, if I was to put myself kind of in a client's shoes, I would say, first just go off and educate yourself. Like, go online, read blogs, read forums, read reviews, see who are the top property managers in your area. And then I think you need to decide what you want, because there's a couple of different ways to skin the cat. So do you want to be involved? Do you not want to be involved? What's most important to you? If you're an investor and you're using a DSCR loan, it's probably the bottom line. And in that case, it's like, how do I make the most amount of money? And we got to maximize for that. But if you're growing a portfolio or you're an investor, you probably need to be thinking more about growing the portfolio, not specifically about maximizing the bottom line for every property. Like you need to focus on acquiring more and growing, and you can't do both. And then
so you're investing more. You're investing in that scenario. It's like you're investing more. Maybe you're spending a little bit more in a property management team that's kind of a set it and forget it versus maybe not, and you're a little bit more involved, cheaper, more involved. That's kind of the
stick with what you're good at, right?
Right.
If you're an investor and you know how to find the right properties, that's a skill and that takes a lot of time. And if you're using a DSCR loan, like you've got a lot of capacity to purchase more. So just focus on like building and growing that, not on like management's not fun. I'm not gonna lie. Like it's nobody likes dealing with a property manager. Like it's a thankless job is the reality.
You gotta be a certain breed to even do it. You really do. It's you're gonna have a certain personality. There's definitely certain characteristics to be a strong property manager, I'd say, and a lot of people don't have it, so it's important to know. So, all right. Well, I guess at this point, last parting words, or why do people choose RedAwning? Let us know, Andreas.
Yeah, so I think like going back to just deciding what you want. Basically, you have like local property managers. You've got hybrid. You've got people. What I'll call is like the same thing you would do as a long-term rental landlord, like, maybe dealing with some like maintenance and landscaping and stuff like that. You have to deal with those communications and you pay the cleaners, but the company would handle all of the guest communications, all the marketing, all the revenue management, everything else you need to do. So just pretend like you continue to operate it like a long-term rental management. Those are like the 3 different like levels of service you can get. At RedAwning, we offer all 3. So our services range from a 10% revenue share to a 25% revenue share. There's no upfront costs. We make money when you make money. If you want to be more on that side where you're handling some more of those things like you would as a long-term rental landlord, then you can do that and you'll be on the lower side of that scale. If you want us to handle everything for you, then we can do that too, and it'll be on the higher end of the scale. So it really just depends on what you're looking for, and I think most people enjoy and like that flexibility, and that's why people choose us. And then guests also like that flexibility. We have flexibility when it comes to cancellation and cancellation policies and seasonality with cancellations. It can get kind of complicated, so most companies don't do that. It's just they set a strict cancellation policy, but the reality is that leads to less revenue, and so
that's a huge perk.
Yeah. And then I would say RedAwning started off basically aggregating what we call OTAs, or online travel agencies, which are like the Airbnb, VRBO, Expedia, Booking.com, like all of those different ones. And so we're on 50+ channels because we started off basically helping other property managers aggregate all that information and get it to different sites. And so, we really do have the largest and the strongest distribution. And basically the ability to eventually get a Supro. So each individual one of our listings, it will be for that specific property. And lots of other property managers have a parent listing, so you can't actually get specific reviews for your property. So I'd say overall, that's why people move forward with us. But at the end of the day, you really just have to figure out what's best for you. And sometimes property management is right for people. Sometimes other people self-manage. It just depends on the person and what you're looking for. So, my final parting words would just be, educate yourself, read online, see what's the right fit for you, and then just, reach out to us. Go to RedAwning.com and explore, chat with some of our people and see if it's the right fit for you.
Well, I can tell you, as an investor that's been scared of short-term rentals personally, I feel a heck of a lot better. I know if I end up going into that space, I'll certainly be reaching out to RedAwning and Andreas. I can tell you that. Thank you for that, Andreas. And also thank you, Chelsea. Your expertise is excellent, and we really appreciate you and everything you do for Beeline Loans and for our clients as well. So again, I think this pretty much covers it in our time for today. Listeners, I hope you found this discussion beneficial for your next home purchase. Have a great rest of your day, everybody, and thanks again.
Yeah, bye. Thanks, guys.
Awesome. Thanks. See ya.
Have a good one.